Ladies and gentlemen, good afternoon. Welcome at the first webinar of the Financial Forum in 2022. As we are still in early January, I wish you all, also on behalf of the National Bank of Belgium and the Financial Forum, a happy and healthy 2022. I hope we will be able to meet physically soon and have more normal interactions which are enriching for all of us. On the topic of today, I will provide you with some introductory remarks before I hand over the floor to our two specialists of today, Jacob Gintelberg and Christine van Rijsegem. The objective of stress test is simple, in the sense that it answers very important questions. Could the bank weather the storm? Would it survive? Or how much additional capital is needed? Today, and more than a decade after the global financial crisis, the sovereign debt crisis in Europe, and in the midst of a pandemic crisis, the role of stress testing seems obvious. However, it's only recently that stress tests started to play a central role in the world of banking supervision. Stress test was used as a key tool to address financial vulnerabilities and complement standard capital ratios with a focus on tail risks during the global financial crisis. It helped assess the amount of capital required to redress the banking system and restore confidence. The disclosure of stress test results provided market participants with comparable information about the bank's balance sheet. Eventually, the transparency helped to reduce uncertainty and reassure the market in a system which is built on trust. The first EU-wide stress test was conducted in 2009, which was coordinated by the predecessor of the EBA. Later in 2011, stress test was a tool to guide national supervisors assess capital needs in a European perspective. In 2014, in Europe, the stress test provided comparability between banks from 19 countries and helped implementation of the transition towards a European single supervisory mechanism. Currently, the stress test in Europe is a regular biannual exercise. The latest results were published in July 21. We are discussing today's stress test in the banking sector. EIOPA published more recently results for the insurance sector, but as said, that is not within the scope of today's webinar. However, as mentioned, stress test is a relatively new exercise and supervisors had a steep learning curve which did not go without incidents. I think several people in this audience remember sadly the Dexia case, which showed signs of significant vulnerabilities less than 3 months after passing the 2011 stress test. The Dexia example highlights one of the major challenges in stress test design is that the scenario cannot cover all risks that banks might face. Of course, the lesson was learned, and now we have a better understanding on how to interpret the stress test results. The pass or fail approach is not appropriate as it gives the impression that stress test covers all tail risks. The Dexia example also shows why in Europe we attach a significant importance to the disclosure of detailed information to allow for market analysts to correctly understand banks' vulnerabilities, but also to identify its blind spots. Several years later, the main objectives being unchanged, which is to understand the impact of a tail risk scenario on banks, stress test serves also additional purposes now. It is the main input to determine additional capital requirements, or what we call Pillar 2 guidance. One additional positive spillover of stress tests is that it triggers a dialogue between the bank and the supervisors. The several rounds of interactions with the banks during the stress test exercise will encourage banks to question the quality of their data and projections and their view about their own vulnerability. Banks also conduct their own stress tests and they need to have good systems and models for it. Participation in supervisory stress tests will also test the bank's ability to perform their own projections and benchmark them against their peers. Stress test also serves a macroprudential purpose as it measures to what extent a large economic shock could affect systemic banks together. And it provides sufficient data to identify potential macroprudential vulnerabilities. Although stress tests coordinated by the EBA in Europe served a great purpose, we are now in different position as before. As supervisors, we have invested in collecting granular information, and we have now at our disposal transaction-level data for derivatives, securities, loans, and we might be able to use those data to change the way stress tests are conducted. The supervisors can take over part of the projection based on the acquired data, and the banks can focus on elements that are specific to their business model and portfolios. We can then increase both efficiency and realism of the exercise and improve projections. There is also the question of climate risk that become more urgent, and we should understand its implication on our financial system. While the future of stress tests is still under reflection, we have first Jacob Gintelberg to talk about the past, present, and future of stress tests. He will probably elaborate on some of the elements I have just mentioned, but I'm sure he will be very insightful given his experience. Jacob holds a PhD from the University of Copenhagen and had previous positions in the banking sector as Deputy CRO of Nordea Group and worked for 13 years at the BIS. He is currently the Director of the Economic and Risk Analyst Department of the EBA. He's got stress tests in his portfolio, and he's probably the best person to give you insights about stress testing and its future. For the second part of the webinar, we will have a bank's perspective. Our speaker is Christine van Rijsegem, Chief Risk Officer and member of the Executive Committee of KBC Group. Christine has a long experience within the KBC Group, who participated in the EU-wide stress test exercise since 2009. Christine's presentation will certainly be complementary to the first part. Before I hand over the floor, two practical issues. First, you can raise questions in the chat. We will select some of them for a Q&A session at the end of the webinar. And second, the webinar will be recorded, and the recording together with the slides will be made available after the webinar. So now I hand over the floor to Jacob. Please, Jacob.
Thank you, Joe. Thank you for the introduction, and of course, thank you for inviting me. It's a pleasure to be here and gives me an opportunity to explain what we're about to do going forward, and also I think hopefully it gives me a chance to answer a few questions along the way. Yeah. So without further ado, let me get going. Right. Let's just, as you did, Joe, let's just take stock of what we have done. We've been doing this for a decade, right? So 5 exercises since 2011, and clearly a response to the global financial crisis in 08-09, where I think the people were a bit shocked as to the veracity of the downside shock to the economy and the financial system back then. What we do is that we do a bottom-up exercise. So we have roughly 50 banks do the same exercise with a common scenario and common methodology. So this is an exercise that's focused on comparable, comparable exercise where everyone is subject to the same shock and with the same set of, let's say, dimensions of downside risk imposed on the balance sheet of the banks. We cover quite a bit of the assets in the EU banking system and quite a few countries. I should say this is it's a big exercise, right? It's a lot of work, not only for the banks involved, but also for the supervisory authorities that participate and quality assure and make sure that what is delivered in at the end is healthy and of high quality. As Joe said, we have a number of things that we hope to achieve in doing this. First of all, of course, we hope to identify risks and vulnerabilities in the banking system and look at the resilience of banks to severe adverse developments, but also guide at a micro-prudential supervisory level, guide supervisors in terms of looking at the banks and saying, okay, do banks have enough capital and not enough loss absorption buffers and also mitigating actions at their disposal should a bad outcome occur. And again, ultimately here, what happens is that the input is taken into account when supervisors look at and review the position of banks. And that means ultimately it's not just the bank's own stress test and capital adequacy and liquidity adequacy assessments that play a role when supervisors evaluate the robustness of a given bank. They also look at what was the outcome of the EBA stress test, what's the guidance and insight that comes from this large exercise. So ultimately, this may be input that causes supervisors to challenge either a bank's capital position or its dividend plans, and basically saying, look, guys, you need to hold back a bit. You need to build up a larger buffer, right? Because you don't look sufficiently robust against the downside risk scenario. I would say what's been going on over the last decade, I think, is also important in terms of acknowledging that it's been a good exercise in terms of supporting and fostering the investments by banks in enhancing their own stress testing capability and risk management capabilities because they've had to participate in this demanding exercise. I'm sure that the banks that participate, and this is what we hear from the banks themselves as well, see this also as a way to get a better handle on their risk capacity and hence their overall risk envelope of the institution, which I think is a key element from a supervisory and financial stability perspective here. So I think this notion of the investment and the competence building inside the financial system has been an important element up to now, and it will continue to be on the radar screen of us at EBA, but also the supervisors. Finally, the point that comes out, and that I think is, Joe mentioned that as well, and I think that's a very important aspect as well. Having this kind of exercise that creates a comparable set of numbers across a wide set of banks, I think also should help by enhancing transparency and comparability across banks, and hence hopefully market discipline, right? So if a bank stands out, either good or bad in the exercise in terms of its robustness, hopefully this will be reflected in the market prices of its debt, the equity price, etc., but also the perception of the bank overall. So these are some of the reasons why, and hopefully the benefits from doing this exercise. Yeah, right. Now moving on to the present, let me just do a quick recap of where we stand in terms of the robustness of the European banking system and what we saw in our latest stress test. I'll try to be quick, but overall I think it's clear that for the most part today, at least at this point in time, banks have a capital ratio which is pretty well above the regulatory minimum. So we have basically taking into account all of the rules and the regulations that are there and also about to go live. Banks have on average a ratio of 15.4% as of Q3 2021. That's a high CET1 capital ratio for banks. And it's actually 100 basis points above what it was before the COVID pandemic began. So I would say, as you can see from the chart, it's stabilized. And that picture, by the way, is also reflected in the leverage ratio of banks, which is a simpler measure of basically capital to assets for the banks, right? So you can see there has been a sort of, from a supervisory and financial stability perspective, a good development in the capital adequacy of banks during the crisis. And I'm sure that this has also meant that banks have been able to actually support the real economy in the recent couple of years, which have been difficult. And to my mind, this is why we're doing this, right? The whole reason for having these types of exercises is to ensure that banks can also support the real economy in bad times. So I would say if you look at what has been going on, you can see that there's been quite a bit of variation in how ratios have gone up across the between 19 and 21. That's the lower chart on my slide. You can see that the CEE countries have had a little bit more of an increase, but most banks have seen a small increase as dividends have not been paid out, and there's been sort of a limited negative asset quality impact on the banks during the pandemic due to the support measures from fiscal policy and monetary policy. Now, if I turn to the 2021 stress test results, what are the highlights? So I think we have a couple of things we can say. Overall, a very severe scenario. So a 500 basis point decline in the CET1 ratio. So that's, as you can see, quite a severe test of the bank's balance sheets. We see roughly a decline of roughly 260 billion euros of capital that gets lost in a downside scenario. And we have an increase in risk exposures of around close to 900 billion. But still, so even with this quite severe downside scenario, you can see that we're having, on average, banks stayed above a 10% capital ratio level, which is comforting. Yeah, so that means on average, the system is able to withstand quite a severe shock, even with that magnitude. Now, if I would say this, though, I think it's also important to note that we have quite a bit of variation across the banks that participated. Some had an impact of close to double the 500 basis points. Others have had a lot less. So there is quite a bit of variation across banks, which also reflects, of course, that the balance sheets of banks look very different from the get-go. And I would just flag when I say severe, I've given you the numbers for the 2018 stress test, where the shock was roughly 400 bips in terms of decline in the CET1 capital ratio. And I would say here, for me, this gives it's a comforting message, but it also, I would like to stress that not all banks are on an equal footing here, right? Some are much better capitalized than others at present, right? Now, if I look at how banks are affected in this kind of severe stress scenario by type of bank or type of book, if you will, first off, we can see that those that have more of a domestic market focus, they are less robust. They took a bigger hit. So that was closer to 600 bips decline in the CET1 ratio versus the average of 500, whereas the ones that had more diversified books took a slightly smaller hit, still close to 500, but it's still noticeable that there's a 1 percentage point difference here. Also, when we look at how banks are doing, another distinction is if we look at the banks that have high net interest income versus low, then the ones that had a high earnings level obviously have more of an income buffer to spend on absorbing losses, and hence they only saw 350 basis point decline in their capital ratios, whereas the others were 550 basis points roughly, right? So again, having a good earning level in terms of net interest income is in effect a buffer in a severe scenario. But it's a 200 basis point difference, which is quite substantial, I would say. If we look at the size of the banks, that doesn't seem to matter a lot in terms of how one does in a stress scenario like this. Yeah. So again, there it's roughly 500 basis points for both small and non-small banks, right? For large and non-large banks. But that gives you a sense, right? So having a little bit more diversification and having a higher net interest income level will help you fare better in a stress scenario. I mean, it shouldn't be a surprise, but at least it comes out quite clearly in the exercise, which is in a sense telling. If I move on, here's sort of a waterfall just to give you a sense. as to where the losses are. And what you can see is that the big chunk of the losses the banks experience in the type of scenarios that we run is the credit risk losses. They make up the vast majority of the overall 500 basis point drop that we saw. You know, still market risk and op risk losses are still there, but they're clearly less significant than credit risk. You can see the market risk total is probably 1% down, op risk close to 1%, but not quite. And then REA takes the last takes 1 more percent, as you can see, right? So overall, we get on the loss side, we get a clear picture that it is the credit risk bucket, which is the big ticket in these kinds of exercises. But still, you know, op risk, market risk, and REA increases is still roughly 3% in total, right? So the 3 smaller ones are close in size when I sum them up for the credit risk loss. Yeah, but that gives you a sense of what balance sheets look like. Again, maybe not a surprise, but it's telling that it's so noticeable. If we move on a little bit and take a look at some details on the credit risk impact in the stress scenario. First of all, we saw this time around we had a slightly higher increase in provisions compared to the previous round, and we had notably more of the bad provisions, where things were really troubling. And then also we could see that the starting point for banks when it comes to credit risk this time around was stronger, right? So we had a better book to start with when we went into this exercise. Again, total well over 400 basis points came from credit risk, pretty much what we also had in 2018. If I'm to say what we found out, well, you know, we started out with more robust banks in terms of capital adequacy. We took a more severe scenario. We got a 500 basis point drop in the CET1 ratio, but on average, banks still remained above 10%. Credit risk is the main ticket. That's been the same as previous years. We had noticeable dispersion across banks, so not every bank is as fit for fight as the other. And I would say, if you ask me, I would say it gives us also a sense looking ahead. It gives us maybe a sense of which position banks will be in when we come out of the pandemic, which I hope we will soon. It doesn't seem like it right now, but let's hope, no? And also, as you see here, some of the banks that fared less well, I'm sure this will be part of the SREP process. And equally for the banks that came out quite well, I'm sure that will also be reflected in the SREP discussions that are taking place across Europe as we speak now. I look ahead. Here, a few things I'd like to say. There's a number of dimensions. Joe touched upon the first one, which is how do we go about conducting the stress test? And I think we are actively, and I think we've been doing that over the years, continuing to try to improve the realism of what we do. So that means that when we look at the scenarios we expose the banks to, and the risk dimensions we stress, obviously we want to do something which is relevant and realistic when we look at the state of the world, right? Now, I would say overall, for the next round, I think it'll be mostly business as usual when it comes to credit risk and market risk. Those are the areas where banks have probably the most sophisticated and well-functioning setups today. But still, we are considering, to Joe's point, we are considering how we can maybe move away from a full bottom-up in areas where it may not make a whole lot of sense to do it bottom-up, where we have enough information of where the nature of the stress is really such that perhaps we don't need to do a bottom-up version to get and meaningful ideas to the robustness of each of the banks and the system as a whole. So what we're doing is we're looking at introducing a hybrid approach by complementing what the current constrained bottom-up approach with top-down elements for some areas of the bank's balance sheet, right? Here, I think the main areas we're zooming in on at present, at least, is net interest income and net fee and commission income, which are areas that we have, I think, collectively as regulators and supervisors deemed the most realistic to start with in this process. So that's for the 2023 stress, and I'm happy to take questions. I'd like to, however, to also cover, I think, the new kid in town, namely a climate stress test and what's going to happen there. Now, first of all, I would like to say that I know that the SSM as supervisors are conducting an exercise in 2022 looking at the banks they supervise. This is not an EBA exercise. I think it's one that we hope to learn from as we go forward here, because we are at the EBA, we are being asked by the European Commission to basically start conducting ESG climate change stress tests for the banking industry. Now, we're not the only ones that are being asked. As Joe hinted, IOPA also does stress tests, and so does ESMA, by the way. So they have also been asked to do stress tests of the entities that they supervise focused on climate change. We've also been asked, and I think we're still discussing exactly how we will do this, but we're also being asked to conduct a one-off system-wide climate change stress test together with ECB and the other ESAs, so ESMA and IOPA. And I think we're looking down the line as to how we can include climate change ESG aspects into stress testing longer run. Again, here the question is how to do this and how one best embeds this into what we're doing today, because obviously there is a limit to how big an ask we can impose on industry, but also, quite frankly, on the supervisory community, which has quite a bit of work ahead of it when it comes to the Basel III finalization of the implementation of it. Finally, we're being asked to draft guidelines, both for banks and supervisors, on how to approach climate risk stress testing. So this is going to be an active area of engagement for the coming years. So this is the new thing that's going to come in. Also, we are in light of so we knew this was coming. It's not a total surprise, I guess. So we've already conducted a pilot exercise with good collaboration from banks to try and identify where the challenges are. In my slide deck, there's a bit more in the appendix on this exercise. I think here the lessons were mostly related to data challenges and methodological issues, but clearly we're trying to take the learnings from that exercise to see what that implies on how we go forward when it comes to climate stress testing. I would also say, as a general observation here, one of the challenges I see when it comes to conducting stress testing is we need to agree not just on the bad scenario or the adverse scenario that we use. We also need to have a clear debate and a clear head when it comes to looking at what is the baseline scenario. And when it comes to the climate change aspect and how we stress test there, I think that is an equally big challenge. What is the baseline scenario? What do we think will be the path that will be followed in Europe and the world? And how do we stress that relative to that? So I think the relativity point between the baseline and the stress or downside scenario will be a more active area of investigation and analysis for us. This is one of the challenges I see. And right now the debate on climate change is a little bit muddled in that respect, because this is difficult, right? We don't have good detailed climate risk data and what that means for the exposures of banks. So we need to work a bit on understanding what climate change and ESG factors, how they flow through the balance sheet of banks as risk drivers. If we believe, based on the scientific advice we're being given, that there will be more climate change driven risk that will flow through the economy and hence banks' books, we need to have a way to translate that view of the future into a baseline scenario as well as a stress scenario when it comes to climate change. Yeah. Now, obviously, we are working together with EU supervisors here at the EBA, but we're also working with other partners around the globe as best we can. So we are trying to engage in as many smart people as we can, right? So we're talking to the US, South America, Australia, Asia. We're trying to branch out, and obviously people who are active in this field are teaming up internationally outside Europe as well, with the Europeans clearly a strong player here. But we are working, I think, at a global level to find out how to best approach this. And there are choices that need to be made. We need to consider, are we satisfied running just a bottom-up thing for banks, or do we want to dig in deeper and have a more comprehensive look at not just banks, but also how the risk sharing between banks, governments, households, and insurance, how that works out sum total? Because I think the allocation of risks when it comes to the impact of climate change is an open question. That's something we need to analyze closer and more thoroughly to understand who actually ends up holding the bag in a bad outcome. Because it's not only the banks, right? There's also sovereign fiscal exposure, there's the whole insurance industry, and people who bought financial market assets will also be, that means pension funds will also be holding the risks here, right? So I think we need to have there's some work ahead of us in that space to understand that. Also, we need to look on the time horizon of how we do this, because if it's true that the risk that comes from climate change is a 20, 30-year change, we need to figure out how do we take that projected challenge into account today and build up the necessary buffer so we ensure that the banking system and the financial system more widely can continue to help fund investments in the transition to a more sustainable economy, which again is what this is about, right? We're doing this to make sure that we have a financial system that can in fact facilitate and support the change of the economic machine so it becomes more sustainable. I think that concludes my presentation. I don't think I've spoken enough. I can also hear my voice disappearing gradually here. So, so thanks, Joe. The floor is yours. Yeah.
Thanks, Jacob, for this comprehensive overview of the stress test landscape. Very interesting. We are now just changing the scene, and Christine van Rijsegem, CRO of KBC Group, will share the stress test experience from a bank's perspective. Curious to know if Christine is as enthusiastic as we are on this tool. Christine, the floor is yours.
Thank you very much, Joe, and good afternoon, ladies and gentlemen. It's an honor for me to be part of this webinar, and it is indeed with great pleasure that I give you today the bank's perspective on the EU-wide stress testing. I do not know now if on the screen we have the presentation on the screen. Yeah. I often compare stress testing with a kind of health check for sporters who want to participate to a pro endurance event. As some of you might know, I mean, when you are doing that, you need to have a valid medical certificate. And if you do not have such a certificate, you have to undergo a medical examination. And that medical examination It starts at an easy level, then it's gradually increased until the point where you break. And then afterwards, you get feedback, you get to know whether it's safe for you to perform sports at all and what the optimal conditions are for you to train. Well, checking your health is not only important for sporters, but also for banks. Indeed, stress testing is, in my opinion, an important element in assessing the resilience of a bank in adverse conditions, and so also for KBC. And every financial institution has to be prepared for different outcomes. Therefore, it is very important to look beyond the business as usual and to indeed identify the key risks to which your financial institution, in our case, KBC, is or are exposed to measure the potential impact of these risks and, of course, to act upon these potential impacts. Let me give you an example. I think all of you, including KBC, we are today confronted with a key risk, i.e. cyber risk. And one way of testing your vulnerability is ethical hacking. That is also the case for KBC. And these ethical hackers, well, they help us to prevent cyber attacks and security breaches. And they do that by lawfully trying to hack into our systems, to look for weak points, to exploit vulnerabilities. And they follow the steps and the process of a malicious attacker. They gain as such access to our systems, they test our strategies and our network. And then afterwards, this info is of course shared with KBC. But irrespective of the application, 4 process steps can be identified and distinguished in every stress test. And the first one is what we call the identification, the setup. It means that you need to be very clear in terms of the objective of your stress test. Is it to identify the weaknesses and vulnerabilities, or to challenge your business plan, or to underpin the capital and liquidity adequacy, etc.? The second one is then, of course, obviously, the calculation and also the analysis. That is, of course, the core of the actual execution of the stress test. The third step is reporting. You need to have in every sound stress test process adequate decision-making by installing a systematic reporting. You need to do that to the appropriate management bodies, and that needs to be to the point, easy to understand, and with the aim, of course, of triggering discussion. Because the last but not least, based on the outcome of the stress test, you need to decide, of course, what kind of response you give to this stress test. Within KBC, we do a lot of integrated stress testing, and we consider that as a very important tool to assess to what extent our capital is adequate to cover our risks. Also, whether our profit generation is sustainable and is under various conditions. It complements, of course, the stress testing per risk type, and it looks into the interaction and the combined impact of stress across multiple risk types. And it goes from mild to severe or even extreme situations. For KBC, we link it to, for instance, the yearly planning exercise. We link it to, for instance, the recovery plan. But we can also link it, of course, as I assume all of you did, on an ad hoc basis. And the obvious example is, of course, what we did at the beginning of 2020 with the COVID-19 situation, because at that time we had very little information on drivers, on impact, etc. And in those circumstances, stress testing, including possible outcomes, was indeed an important tool to assess the potential impact for KBC. In all of this, proportionality is, in my opinion, a key principle. Depending on the scope and on the purpose of the exercise, you can either have very heavy exercise or process, and that is, for instance, a fully integrated stress test, or it can be light when we want to have a kind of sensitivity analysis on, for instance, one P&L line. And proportionality that is also important on all aspects of stress testing, also in terms of the impact on your resources, on your data, quality, verification, documentation, and etc. Now, we have, of course, had the presentation of Jacob, and of course, already illustrating that a lot of regulatory stress tests has also been identified. We are talking about the EBA stress test. Joe has also already mentioned EIOPA stress tests for insurers. And in those regulatory stress tests, well, the assumptions and the output templates are indeed imposed by the regulator. When we look now from our perspective to the EBA stress test, and when I look to the setup of the stress test, indeed it was not a pass or a fail test. It was indeed no hurdle rate. All the banks had to use the same scenario, the same methodology. So it was a 3-year projection on the end of the year 2020 actuals, and we had indeed a base and an adverse scenario with a constant balance sheet assumption. And that is, I think, also an important element. We had to use, all banks, we had to use the same methodology, the same scenario. We could use our own models for some projections, but these were also subject to the challenge from the EBA and the ECB, and they used a lot of caps and floors. And so this was indeed, as it was already mentioned, what we call the constrained approach. Now, this was a very large data collection exercise. To give you an idea, in our case, for every submission, we had to deliver up to 250,000 data points. This is, and this was quite a big challenge because the data which were requested were not always standard. We were in the last EBA stress test, we were in the midst of the COVID crisis, so a lot of COVID-related data were asked for. And of course, I mean, these requests were putting a lot of challenge to the banking sector, I think, as a whole. And undoubtedly, it will pose every year a challenge to the banking sector. Challenging was also the timings, because there was a very strict and challenging timing imposed. But what about now the internal use? And I will presumably disappoint some of the people in the call, but the internal use of this EBA stress test, as far as I could see for KBC, was rather limited. It is true that it was a challenge for our data collection capabilities. Were we able to deliver in a qualitative and a timely manner? But taking into account the constrained approach, the outcome of this stress test had actually limited internal use compared to the internal stress tests that we are doing, because they have a similar setup and they are performed internally each year. As it was already mentioned by Jacob, well, also for us, the outcome of the stress test was mainly used for benchmarking with other institutions. And it was indeed already also mentioned that the demand on resources, and this not only at the level of the banks, but also at the level of the ECB and the EBA, was very, very substantial. The stress test, I think, started in February and ran, I think, until the end of July. And so this was quite challenging. Now, what was the outcome of the EBA stress test? Jacob has already highlighted this, but when we look to analyst reports and to what the external market was interested in, well, on this slide and on this graph, I think this is quite clearly illustrated. Here on this graph, the different financial institutions were compared according to, on the one hand, the horizontal axis, the trough stress CET1 ratio, and on the other hand, the vertical axis, That is the drawdown in CET1 ratio. And then you have 4 quartiles, and the best quartile was the one where the trough stress ratio is situated above 11% approximately, and the drawdown was not higher than 5%, or more correctly, minus 5%. And we were, of course, very happy that KBC was firmly situated in the best quartile. We had a trough stress ratio of 14.07% and a drawdown in CET1 of 3.5% over a 3-year horizon in the adverse scenario. When I compare this now, and when I link that to the slide Jacob has shown, well, we are a domestic bank with a 351 basis points impact. We were quite lower than the 564 basis point impact that Jacob showed on his slide, and also much better than the average of 500 basis points, and with 14.07% as trough stress ratio, we were well above the 10.2% average for the sector. The external impact on KBC of the EBA stress test, there I want to make a distinction between the ECB and the market. Let me start with the latter. Again, perhaps disappointing for some of you, the market showed limited interest. In the case of KBC, we exactly received 2 questions. 2 questions from the analysts on our stress test, and both were related to the impact of the stress test on capital. They did ask, however, for more disclosure on capital targets, not only with regard to KBC, of course, but also with regard to the sector. As far as the ECB is concerned, well, also their benchmarking was, of course, aimed for. And as already mentioned, the input, it's important for them for the input for the supervisory review process. The quantitative outcome of the stress test directly links to the P2G target. Now, some of you will know that the ECB provided more disclosure where banks end up by using a so-called bucketing approach. And that was a new ECB disclosure. It implied a range of 0 to 4.5%, but it also meant that even 2 banks, which were in the same risk quartile, could have a 275 basis points different CET1 need, one from the other. It is clear that here the market expected more detailed information. And then you have the qualitative outcome, the qualitative scoring. How did you perform the stress test? How did you do in terms of data quality, in terms of cooperation? Well, this is supposed to impact the P2R capital target. Now, for us, and I think I can also speak on behalf of the sector, there is still an opaque link on how this influences the P2R. And we certainly advocate for more transparency from the ECB towards the banks on how the P2R is exactly determined and how the outcome of the stress test impacts this. And by the way, going forward, we also are in favor of course, a balanced and proportionate way. The current initiatives, and we heard some of them call them the hybrid approach, others the 2-legged approach, where the first leg would indeed largely cover the approach of today, and the second leg would be less constrained, and where it would be able to make use of internal models. Well, here we believe also we should be careful, because we absolutely want to avoid that additional workload is being created, and that reconciliation would be asked for or would be expected without much added value. We rather ask the ECB to look to the individual stress testing capabilities of banks. Let me move now indeed to another top risk that we are, and you are undoubtedly also confronted with, and that is indeed climate risk, or more general, ESG, of course. And ESG, as well as their associated opportunities and risks, they are becoming, of course, more and more relevant for financial institutions, also for, as we have seen, for regulators, for supervisors. It's also the case for KBC. And that has already been evidenced by our strategy update, for instance, that we have done in November 2020 already, during which we announced that also in this on this one we wanted to be or to remain the reference, and that we were substantially raising the bar for climate-related ambitions. And our sustainability strategy is already translated in the selection of this publicly disclosed KPIs. The volume, for instance, of SRI funds, percentage of renewable energy loans, the fact that we have exited, for instance, direct coal finance, etc. Now, today, indeed, we experience that climate risk is given a lot of attention, and the data and methodologies are starting to be developed. And as it was already mentioned, currently there are no industry methodologies in place yet to address these risks. So how are we doing this within KBC? Well, we are doing this in a gradual way. We are gradually integrating ESG risks in all our existing risk management processes. And we strongly believe in this gradual process, in a step-by-step approach, where we have follow-up actions which will be defined based on the insights that we have gained from previous actions, from previous analysis, and of course also dependent on the availability of the data and methodologies. Now, I truly believe, and I think a lot also with me, a lot of people with me, that the financial sector is indeed expected, and rightfully so, to play a significant role in climate transition. However, I believe that we should avoid that this sector has to assume the full burden of what I call policing. I do believe that addressing climate risk is a shared responsibility between the financial sector on the one hand and governments and the public sector on the other hand. Now, it goes without saying that we all want to understand the drivers and the impact of climate risk. And Jacob has already mentioned that it's an uncertain path, etc. But I also believe there is a high degree of certainty that some combination of physical and transition risk will materialize in the future. And it is true that the exact outcome, the time horizon, and the future pathway, that these are uncertain. But here, I believe that scenario analysis and stress testing, that this offers a flexible what-if methodological framework to indeed explore the risks that could materialize in different possible future states. Now, at KBC, the climate risk stress scenarios that we will consider are based on scenarios developed by the Network for Greening the Financial System. You might know, I mean, this is a group of, I think, 60 or 66 central banks and supervisors, and also some observers, and they are committed to share best practice and to contribute to the development of climate and environmental related risk management. And what we have done now, we started the development of a climate risk impact map, and we reflect in that climate map to what extent we will or we might be affected by physical risk and transition risk. This for different time horizons, short to the long term, and for different climate change pathways. And this impact map will also indicate through which traditional risk types these impacts might materialize. And so we are incorporating climate-related risks more explicitly indeed in the stress test, in our stress testing and in our sensitivity analysis, we believe that this will indeed, the stress test, be a learning opportunity for KBC and the sector as a whole in this domain. Now, the upcoming climate stress test will prove to be very challenging. Again, as data and methodologies, as I mentioned, are still in the development phase, we will have to deliver a lot of data, and it will even be, I think, more challenging than the EBA stress test. And let me give you two examples. The first example is on greenhouse gas emissions. You might know these are categorized into three groups, scopes. The first scope is everything with regard to direct emissions, the second one on indirect emissions, and the third one on all other indirect emissions. And we have to report on these three categories, and we need to do that for our main corporate counterparties. But now only a limited number of counterparties have made that assessment, so it will be challenging to collect the data. The second example is on EPC, the energy performance certificates, the EPC values of real estate properties. We have to deliver information based on an EPC segmentation for our mortgage and real estate book, and not all real estate properties have received such a certificate, and so this will be quite challenging. And by the way, how the EPC is determined also differs per country. So also on the projection side, this will be not easy. It will not be a walk in the park, because we have to project 9 scenarios, split in transition risk and in physical risk. And then within the transition risk part, there are 3 scenarios: the orderly, the disorderly, and the hothouse. You need to cover there the short term and also the long term. And the main challenge is, of course, to translate those scenarios into concrete impacts. Also, the projection of our balance sheet. Everyone will need to make an evaluation how the balance sheet will be composed in 2030, in 2040, and in 2050. Not an easy exercise, knowing that climate risk has so many different angles. And in the physical risk part, it's a shorter time horizon based on a drought and heat and a flood scenario. And again, all this information will also need to be delivered within similar timings as the EBA stress test. I would like to conclude as follows. So this is my last slide. Well, we see challenges in the stress test here, data collection, forecasting, but we believe with regard to the climate stress test that this stress test will be valuable, as it will help us, and I believe also the sector, to create awareness, both within our individual banks, but also within the sector, that it will enable us to understand how climate risk will impact the individual banks, but also the economy as a whole. And will also advise on how the impact can be measured. I want to stress, and we have also heard that ECB communicated that this is to be seen as a learning exercise. It's really important, and I would like to stress this, because we believe that no concrete capital consequences can be attached to the outcome of the stress test. But of course, and that's my concluding sentence, KBC and undoubtedly the whole financial sector in Belgium and beyond is committed to complete this exercise in a qualitative manner. So I would like to leave it here. I give the floor back to Joe, and I'm happy to take questions, please. Thank you.
Thanks indeed, Christine, for your very insightful presentation and your open and transparent assessment. We received indeed some questions. I will try to group them by topic. My first question, first to Christine and then to Jacob, is related to the statement of Christine that there seems to be rather limited interest both internally and from market participants with regard to the outcome of the stress test, the results of the stress test. Do you think, Christine, that this is related to the good results of your bank, or is it a problem of design of the stress test and its disclosure? In that case, do you have any suggestions to increase the interest of the market? And the same question to Jacob. But first of all, do you share the assessment and the conclusion of Christine with regard to the interest of market participants? Is that true for the whole exercise, or are market participants maybe more interested in global CFIs or more vulnerable banks? How do you assess that? And if the conclusion would be true, is the EBA planning any actions to increase the interest of market analysts in the future? So first Christine, then Jacob on the same issues, and then we come back on another topic.
Yeah, thank you, Joe. So in my opinion, the limited interest is linked to the design, to the setup, to the constrained approach that I have already been referring to. And I would like to perhaps give a bit of practical examples. And I have mentioned, for instance, I mean, we are a domestic bank. We are a very liquid bank, so we have a lot of non-maturity deposits. Now, a first example in terms of the constrained approach is that in line with the EBA guidelines, the non-maturity deposits are not benchmarked, so they are treated as overnight. And this way, the methodology forces a short-funded balance sheet with longer investments. So it also means that any increase in interest rates is passed on more quickly on the cost side and on the income side. And that is a substantial difference where the ECB/EBA is deviating the most from our internal scenario. And even that accelerates in an adverse scenario. The second one is, of course, I mean, as I mentioned, the constant balance sheet approach. Other ones were, for instance, the like-for-like replacements, where every maturity contract is replaced by a similar contract, and so on. So there was also, I mean, no possibilities for management actions in the methodology. So when we are doing already, analysts are doing a kind of what if analysis, they take, of course, into account the features of your institution and to what extent they can rely on management actions in a business as usual, but also in stress situations. I give the floor.
Can you?
Yep.
Can you hear me?
Yep.
So I think so on the interest of market, on the market interest aspect, I think there's a couple of observations from my side. I think one is the relativity across the banks is what I see as the most interesting, right? I'm not so surprised that maybe individual banks don't get detailed questions on the EBA stress test. That I wouldn't have expected that, to be honest. But I think there is quite a bit of interest in the relativity of the outcome. As we've seen, certainly we get a lot of questions, and we see a lot of reports published that provide sort of an overview, does comparisons, asks questions, right, and probes, and tries to understand what drives the dispersion across the banks. So I think that's what it looks like from my vantage point. I would say, again, I would say inside the banks, again, speaking a bit under I have to behave vis-a-vis my former employer, but I would say there I'm again fair beans, right? I think the EBA exercise is a comparator. It gives sort of it gives an anchoring for what you do yourself, and I think to Christine's point, I think those are all fair criticisms. I think the deposit modeling is an acknowledged, I think, area of possible change where we need to figure out how to do it. I also think, obviously, the constant balance sheet assumption is something one can criticize. I would say that this is a trade-off, right? If we are to move down the path of doing something which is comparable across banks, allowing for management actions will let's say, then we need to establish rules of the game, and it may not make it easier for banks to conduct the exercise. So I think there's probably a price to pay for that simplicity, but certainly I'm also, I would say to Christine, I'm happy to hear that you're very specific in your criticisms, and I'm happy to be able to say that they are the same criticisms that we've heard, I think, from industry in our interactions with industry, right? So we are looking at what to do on the deposit side. I think that's a fair point. It's probably also one that's easier to address to some extent, maybe with a bit more information on the deposit composition. We can change the methodology a bit to make it more realistic, and I think I have no, fair enough. I think, again, on the pass-through of interest rate changes, how that plays out, again, I think we're having that discussion with industry and the supervisors. I think we need to find a compromise. Again, as Christine may know, and you, Joe, may know, we have quite a bit of dispersion across Europe in terms of interest rate levels and what things look like and deposit practices. So we have to rethink, if we are to do something here, it has to be done in a way that is let's say, what's the favorite word, even-handed and proportionate across the union, to not punish anyone in a surprising and unfair manner if we change something. Just to be clear, it's not that simple, because not every bank looks the same, and deposit practices vary quite a bit across, right? So I think for me, I'm pretty convinced that as a comparator, this is useful, and as a regulatory exercise in terms of getting a sense of where industry is and getting some comparability, I think we're probably okay. We can do some improvements, no doubt. I would say interest has been higher in periods where, or in the past, when banks were more constrained, right? So and I think we've seen the same in the US and elsewhere. As banks are now pretty well capitalized and they don't seem to be having challenges staying afloat, if you will, even in an adverse scenario, I'm not so surprised that this is then less of a concern, right? It also means that probably for many banks, KBC apparently included, that the likelihood of some extra capital requirement for the ones that do well is seen as less pressing. What we do here is that there's questions being asked of the weaker banks, right? That's where there's probably a view that this might feed in more clearly into SREP guidance and into supervisory action and demands, right? So I think there is a difference in the response on how well you do, but is it a big one? I don't know. I'm not following each of the 50 banks in detail, right? But I do hear comments that if you do less well, you get a bit more of an interest from the market, right? So I think, again, I will say I shouldn't be saying this out loud maybe, but I'm gonna be friendly and say I think it's reassuring when I listen to Christine, again, having arrived from industry. I think it's reassuring to see the stress test is clearly something that's now being used. It's being taken seriously, and it's now part of the risk management practices, right? So in that sense, the nudge from supervisors and regulators to do more stress testing and pushing by having at least a strawman enemy out there that you need to compete with is probably part of that effort that's being put in by the banks to be able to reply to supervisors, right? So I'm also, not everything has a simple purpose, right? The other comment I would make is that, here, when I listen to Christine, and I'm not surprised. I know it's a challenge on the data side and the methodology side for banks when it comes to climate stress testing and looking at the environment and the physical risks and how to translate that back into the book, so to speak. Here, again, I guess the supervisory efforts and including what we do is essentially also a nudge to the banks to invest the money and the resources and the time to enhance that capability in the banking industry, right? Obviously, the question becomes if there's a trade-off here, and there's a limit to how much we can ask of industry. And here I'm also looking at you, Joe. The question really becomes: do we scale back a bit on the old school stress test and increase the burden a little bit on the climate, right? And this is a difficult debate to have, right? Because we're treading a thin line here, yeah. And I think that is a fair debate, Christine. I don't want to say this. This is not. I'm not disagreeing, but we are going to have to. This is not for me to answer, right? Yeah. So.
Okay. Thanks for responding these questions. Maybe a last set of questions around the new paradigm, indeed, around climate stress test. It has been mentioned by both of you. It is economically as relevant as regular stress tests, no doubt about that. But it's of a more uncertain nature, let's face it, given its longer term horizon and assumptions to be taken in terms of innovation, customer preference, and more importantly, even political decisions that will guide the transition path. Based on these elements, it's worth thinking about how the climate stress test will evolve and will fit in the overall framework. And to both of you, maybe first to Jacob, then to Christine, how do you see this evolving over time? Will that remain a separate exercise, or will climate considerations feed the regular stress test assumptions looking forward? That is the general question for both of you. And then an additional specific question to Christine, that is, are bank insurance groups like KBC better equipped against financial and climate stress tests versus pure banks? So the general question to both of you, maybe first Jacob, and then Christine, and Christine can take on the additional question as well. Jacob?
Thank you for not asking me about the bank insurance groups. First off, I would say my expected scenario I see is that we first dip our toes. We have a couple of practice rounds. I think we're having them already now when it comes to climate stress testing. In that process, hopefully we'll learn some lessons, and I think we will also strengthen, by the way, the scenario building a little bit, right? So I think the network for the greening of the financial system, I think that has been in the discussions I've been participating in that network is all about the next generation of scenarios, right? So I think we're going to be doing some competence build up and some experimentation. But down the line, my expectation will be that it gets built in as a standard element in an ongoing stress testing exercise. I doubt that we have the capacity in the system to run a completely separate climate exercise alongside the other things that we do, right? So I would expect it to become part and parcel of an ongoing joint exercise with more dimensions in the scenarios and the stress testing that we expose the banks to, right? That will be my forecast down the line, yeah.
Yeah, so if I can add to that, I mean, first of all, to what Jacob was mentioning in terms of having it integrated within a kind of your normal risk management processes, I fully agree. So that is also, I mean, I hope that this was also illustrated when I took you through the slides on how we approach this within KBC. But in the time part that we have now submitted, it is indeed the purpose to have this integrated, and this in a gradual way, into all our risk management frameworks. So frameworks of all kinds of frameworks, but also, for instance, within our risk appetite. We, for instance, within KBC, we go to the to the Risk and Compliance Committee and to the Board of Directors twice a year to present the risk appetite going forward. And why do we do that twice a year? That is once before we start the planning cycle, because this is the guidance that we give. That is then also from not only the Group Exco, but also from the Board of Directors, the guidance that we give to the different business units for the development of their plan. Then they develop the plan, and then afterwards we present the final outcome of what is in the planning, and we compare this with our desired risk appetite. Now, it is the purpose to incorporate climate risk within, or ESG risk at a later stage, within this whole framework and within all the different components of risk management. In terms of the bank insurance model, in general, first of all, when we look to the EBA stress test and to stress testing in general, it is correct to state, and you know that we are quite a unique bank insurer, not only in Belgium, but also I think in the whole finance community. We have seen in the stress test and also in the financial crisis that we have had years ago, that the diversification effect is very important. And so as an integrated, because we are quite a unique integrated bank insurer company, that this is very important. With regard to climate, well, again, I mentioned this is a gradual process. I mentioned the fact that we have developed this, or that we are gradually developing the climate risk map. We have done this, for instance, and we have presented this recently also to our Risk and Compliance Committee on the insurance side. And we take the three different climate scenarios. We take also the short to long horizon. We split it in the transition and the physical risk, and then we look to different risk components within that, and we try to estimate the impact. Now, at this moment, this is still relatively expert-based, but the gradual approach is exactly there, that as soon as we have data coming our way in a more sophisticated way, that we can refine that and that we can continue to steer our business. Because it is indeed not only about looking to what extent you are impacted in a more global way, but this will have impact on your business, on your underwriting policies, as well on the insurance side as on the bank side. And these will be for a bank different than for an insurance company. And the way that the sector will prepare this also for our customers will be very important. And that's the last thing I want to mention on this question. We often underestimate also the learning process, and sorry for this expression, that not only the banks have to undergo and to do in this respect, but also the learning process that we have to take our clients through. Because some clients are very sophisticated in this respect, but others are not, and we need to also do that in conjunction with our business. So. Summarizing, Joe, yeah, there are certainly benefits in having in being an integrated, diversified bank insurer company, certainly in stress situations. Secondly, on climate risk, there will be specific risks which are unique or rather unique for an insurance company, and that, of course, we need to take separately.
Thanks to both of you for these additional clarifications. Unfortunately, that brings us more or less to the end of this webinar, and apologize for the questions that could not be responded or posed. I would like, first of all, to thanks to the presenters, Christine and Jacob, for the extremely interesting contributions. Thank also to the audience for virtually attending this event. I wish you all a nice afternoon. Bye.